Welcome to the Emotional Balance Sheet, the go-to podcast for parents with multiple kids, especially those with twins, triplets, or more, who are navigating the maze of modern family life and personal finance. Whether you're overwhelmed by education or retirement planning, parenting dilemmas, career transitions, or trying to define your purpose and plan, we're here to guide you with empathy, encouragement, and expertise. Hosted by Paul Fenner, founder of Tama Capital, a certified financial planner and parent to 4 kids, including a set of triplets. Our podcast is your ally in the quest for financial peace of mind, proving that money matters, but family comes first. Subscribe now and join our community of empowered parents at tamacapital.com. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Tama may retain positions in the securities discussed in this podcast.
What does comprehensive financial planning even mean? At Tama Capital, it means a family office where lifestyle planning such as retirement, college, portfolio management, and tax prep and planning are all under one umbrella. But it goes beyond numbers. We focus as much on the emotional side of financial planning as we do on the financial side. We get you. We understand your challenges of building a family, business or career, and a healthy life. We are devoted to wealth planning for families like yours because we are you. Learn how our family can help your family by visiting tamacapital.com. Hi, and welcome back. All right, we're rolling. We're rolling through the one big, beautiful bill, and we have arrived at the building years. The building years, near and dear to my heart because I'm living it right now with my set of triplets plus one. Triplets just started high school this year, and Mackenzie, our plus one, is in 8th grade. So this is the life stage where you've got older kids either moving into high school or moving into college. And there's a lot going on. I'm not quite sure in some aspects if it's all that different from the growth and family life stage that I just covered, because I was just having this conversation with somebody when it seemed like there was a season to life with parenting what I'm referring to, where there was some downtime. But today it feels like it's a 24/7, 365 contact sport. There's very little downtime. And I know some families that are super close, super tight, and they manage that. They're really good at that. And then others, probably like myself and Teresa, that we get managed by the situation. And I think it's I don't think it's a poor reflection on individuals or parenting. Everybody's doing the best they can. I talk to parents every day, all day long, whether it's as part of TAMA, if it's in high school sports or clubs or middle school or elementary. Every parent is dealing with something. And there's no, as I repeat over and over, there's no shortage of personal, financial, lifestyle priorities pulling at us. It's never ending. And so I think one of the reasons why I talk about emotions so much, and I know I'm getting off topic here because we're going to focus on the one big, beautiful bill and how it impacts you at this life stage, is getting an understanding of what it is that you want to do. Being able to take a few minutes to take breaths, just take a breath and step back and think about, okay, what it is that I really want and how can I slow myself down to enjoy these moments? Because I wish I had $1 for every time I've been told, just wait, these years are going to go by so fast. And they already have. And I know that the next 4 years are going to go by even faster. So, with that said, how does the big, beautiful bill impact you at this point in life? Well, here's some good things about the big, beautiful bill. The standard deduction increase, as I mentioned last stage, so it's $31,500 is a standard deduction. I think for me personally, the marginal tax rate staying the same is probably the biggest benefit because it provides some clarity and some certainty around how I can help people plan, not only from a tax standpoint, a college standpoint, a retirement standpoint, and a lifestyle standpoint. So that's really key to me. So that was a big win, because if that had not happened, if this bill had not passed, then all of us would have seen probably a 2 to 3% increase in our taxes. And I'm not sure the economy could have taken that. The other big thing about this stage of life, and it didn't really get impacted too much by the big beautiful bill, but people are probably unaware that when you turn 50, you can now do retirement catch-up contributions. So you can contribute an additional like $7,500 on top of what you're already putting into your 401k up to the max amount. And you get to contribute an extra $1,000 for your Roth or traditional IRA as well. So those retirement catch-up contributions are a big part of this planning that I go through with families. It also, as I'll get to in a second, talking about SALT increase, but I deal with only a handful of small business owners. So if you're a small business owner and you want more detail on this, feel free to reach out. But there are a few key features that help small business owners, such as the qualified business deduction, which is back, along with bonus depreciation. And so those are actually huge when it comes to planning for your personal and your business coming together. So if you want more information on that, don't hesitate to reach out. So I kind of just went through the good things about the bill. Let me share my screen, and I want to dive into a couple specifics and then talk about some of the not so good things about the bill. So let's start with the SALT deduction. So as I mentioned in the previous life stages, it has gone up from $10,000 to $20,000 for married, filing jointly, $5,000, $20,000 for singles. But again, the complexity that they've introduced with this bill should not be lost on anyone. And we're going to talk about this over and over during this life stage. One is the deductions themselves. Some of them have specific years that they're good. So like for this one, it's 2025 to 2029. For others, it may go up to 2030. For others, it may only go up to 28. The other thing that this bill that you need to pay attention to is the phase out, the income phase out ranges for each of these different deductions. So for SALT specifically, if your modified adjusted gross income is over $500,000, that's when it starts getting phased out. And so in this example that I'm showing here, and for those listening, if your modified adjusted gross income is over $600,000, it results in a $30,000 reduction in the tax break. So basically, the cap of 40 gets reduced by 30, which leaves you with 10. And that's the minimum allowable deduction that you can do. That's the cap. That's the floor, or I shouldn't say cap. That's the floor, if you will. And that's my point here is like the floor is $10,000 for married filing jointly, $5,000 for singles. What does this mean again, Paul? It means that if you're in a high income tax bracket, you're still going to more than likely hit this ceiling of $10,000 or $5,000 if you're single. Now, the phase out and the caps increase by 1% each year, but that's not really going to move the needle all that much. So, again, if you're in the, say, $250,000 to $400,000 income range, maybe dual income family, you're still going to be hard pressed to be able to take and itemize your deductions because of the standard deduction being so high and the fact that there's no deductions that you can really take anymore. Most of those were eliminated in 2017, and they didn't come back for this one either. So that's really key to remember. I've covered this as well. The vehicle interest deduction. I don't know how much of this is going to apply for you for two reasons. One is The major hurdle is it's got to be a new car assembled in the US. So in these two examples I gave, if it's a used car, no deduction. If it's a new car made in Germany, shipped to the US, no deduction. But here's the other kicker. Income limitations, phase outs, like I just keep talking about. I'll keep talking about this throughout this life stage, is that with this, the deduction starts phasing out for $200,000 of modified adjusted gross income for married filing jointly, and $100,000 for single filers. So, in this example, if you pay like $8,000 of interest, and you're over that, if you're $20,000 over that threshold, $20,000 times 20% is $4,000. $8,000 minus $4,000, your deduction ends up only being $4,000. So again, like with tips, with overtime, with this vehicle interest deduction, they all get a lot of publicity. They all get a lot of hype. But when you really dig into the detail and peel back the layers, I don't think many people are going to qualify for these at a dual income of $250 or more. And so just keep that in mind and level set your expectations. If like, oh, I heard in the news that I'm going to be eligible for these deductions. Well, you really got to dive into the detail and again understand what these phase out amounts are and when the deduction is actually good for. I'm going to roll through this fairly quickly because this is something, these Trump accounts take place sometime in 2026. There's still a lot of loose ends being decided on some of these. But in essence, what the government is trying to do is incentivize or get people to start investing, for their kids early on. It's kind of like a quasi traditional IRA account. So eligibility, any child 18 or under with a Social Security account or Social Security number can have an account. Let me skip down to this government seeding funding because this probably does not apply to people in our life stage because our kids are all older. But if you're having new kids, maybe you are having kids later in life, if you have a new child between 2025 and 2028, the government will put $1,000 into one of these accounts. So by all means, if you're having new babies, then you're going to want to take advantage of that just to take the $1,000. But if you're not, if you have older kids like myself, I would still prefer people to utilize either really a Roth IRA or continue to fund 529 plans or accounts based on your overall wealth management plan. But from a contribution standpoint, individuals, meaning parents, relatives, whomever, can contribute up to $5,000 in total using after-tax dollars in these accounts. For business owners, this is actually really interesting. This is probably the most interesting piece of it if you're a business owner, is that you could contribute up to $2,500 per year per child. That amount, they think, and this hasn't been decided, will probably go against that $5,000 annual limit, but that could be a $2,500 write-off for your business every year. So that's something to keep an eye on. And again, if you're a small business owner, don't hesitate to reach out and I can maybe help walk you through that specifically. Withdrawal rules, you cannot withdraw funds until after 18. Again, this is kind of working like a traditional IRA. You put money in after tax, assets grow tax deferred, but when you take the money out, the earnings are taxed as regular income. So I just kind of explained that in that bullet point. And then as far as investment selection goes, they have not announced like what the eligible investment lineup is going to be from a mutual fund ETF standpoint, but supposedly there's some strict requirements on diversification, index funds, and fee caps. I can tell you that you will not be allowed to buy individual stocks with these accounts. So again, for the most part, I think these are kind of like hyped up, but if you have kids that are working, that are generating some kind of income from babysitting, mowing yards, even having obviously a W-2 job, you can set up Roth IRA accounts for them. And I prefer Roth for kids versus traditional just because you cannot beat tax-free growth. So that's Trump accounts in a nutshell. So what are the downsides to this life stage that I'm living in with you, if you're in this life stage, that we need to be concerned about? From a capital gains management standpoint, the bill did not do anything to reset or adjust capital gains rate. So there's either 0, 15, 20, plus you have the 3.8% net investment income tax for higher earners. Again, this can get very complicated, but my point here is managing the timing and the structure of asset sales. Think stock options, restricted stocks, assets in a taxable brokerage account. You really want to be careful on managing the sales of those assets versus the tax that you may be paying. Now, let me make this point. These rates are potentially still lower than what your ordinary income rates are going to be. So just keep that in mind. And this is where I'll probably make this point from a planning perspective here in a second, but understanding and managing the tax buckets within your overall portfolio, whether it's Roth, traditional, 401ks, taxable brokerage accounts, 529s even, how you're managing all that to make sure that you're not unintentionally artificially increasing your effective tax rate when you don't need to. Again, this can be very complicated. One of the things that we're dealing with at this life stage is the retirement college saving squeeze. There's real tension between saving for college and saving for retirement tomorrow. And again, it goes back to the point I made earlier with this life stage, is that there's no shortage of priorities pulling at us, whether it's college, just maintaining our current lifestyle, saving for retirement. God help us if we want to take a vacation that's not at a sports facility. So all of that takes into account what I do as an advisor in helping people understand what their priorities are, what their objectives are, and putting together plans that align to that. As I've talked about multiple times already during this life stage, got to be aware of these phase outs. The more income you make, the chances are that you're going to get phased out or that deduction is going to get eliminated altogether. Like I mentioned, all these deductions get a lot of headlines, but I don't think they're going to really provide a whole lot of help at this stage of life. So be aware of that. And then there are a ton of energy credit rollbacks. The one that probably most people are aware of is the $7,500 EV credit that you were getting before is now going to be gone. But additionally, there's home energy credits that are now going to be phased out as well. So these will be like putting in like energy efficient appliances, things like that. So those used to add up. I mean, I've had families over the years preparing their tax returns that those ended up being meaningful tax credits. I had one myself when we went through a major remodel of our house. But that just means that downsizing or remodeling is going to get potentially more expensive. So just keep that in mind. So these are the really downsides of the big, beautiful bill. But again, knowing these phase outs, I think, is really, really key, and when they expire. So with all that being said, what's this leave for planning actions? And as I kind of said in the intro, there's an old Amex commercial that says, membership has its privileges. And so if you're already a TAMA family, if you're already working with me, these planning actions I'm going to go through, I'm already executing these on your behalf. But if you find or you already know the complexities of tax planning, retirement planning, college planning, all of it under a comprehensive umbrella, if you're struggling with that, don't hesitate to reach out. We're here to help and see what we can do for you. So let's get started with these. So maximize retirement accounts. I kind of talked about the catch-up contributions, making sure that you're you're taking advantage of those. Also, leveraging Roth strategies. This is where your income and your income tax brackets really come into play, is understanding when you should be contributing to Roth IRAs or 401ks, and vice versa, when you should be contributing to traditional IRAs or traditional 401ks. There's a lot of planning, a lot of detail that goes into trying to find that harmony between the two, because a lot of people that I've been working with, I've found over the years end up being in a higher tax bracket in retirement than they were during their working years. Well, how's that possible? Well, they've built up so much traditional assets, whether in a 401k and IRA, they have to start taking required minimum distributions on that. You add that income onto Social Security, and all of a sudden you're over these income limits. It pushes you into a higher tax bracket. So it's having a good, and I'm going to hit on this in a second, so I'm jumping a gun, but really having a diversified asset bucket. As I mentioned earlier, strategically managing your capital gains. If you're going to be in lower income brackets, that means your capital gains rate will be lower. So that's something to keep in mind as well. I can't stress this one enough because I live this every day, and a lot of the families I work with do. And it's not necessarily saving or finding this harmony between retirement and college savings and planning. It's just trying to find harmony between overall life from a personal and a financial standpoint. As my kids started high school, it's like I'm just like shelling out cash and checks, I think, on a daily basis for this club or this sport or this event or this activity, and it all adds up. And you want to try to provide the best experience for your kids. And it's hard today, especially with social media and the comparison generation. So, but again, if you have a sound purpose and objectives, you can always go back to. That's your rock. So when it makes it a little bit more tolerable making these decisions, knowing that you can't do everything, but you can do most things, but understanding what those trade-offs are pretty key. Plan proactively if you're a business owner. I mentioned a time or two here about some of the benefits that the Big Beautiful Bill has, but didn't go into details. So if you're a business owner, feel free to reach out. We can have a conversation on what that could mean to you. As I was mentioning just a second ago, diversifying your tax buckets. What do I mean by this? It means having assets in Roth, taxable brokerage account, traditional assets, because it allows somebody like me as an advisor, when you get to retirement, to be able to maximize your after-tax return. That's when you're winning the game, when you're really reducing that after-tax, and you're doing that by some years pulling money out of a traditional IRA. Other years, it might be better to take it out of a taxable brokerage account. And then even in other years, it's taking out a Roth. So it's really key to have some diversification. Everybody wants the tax deduction now. Believe me, I do as well. But sometimes it does benefit not taking that deduction now to be able to ensure greater after-tax efficiency down the road. And then the last point I want to mention on this is this universal non-itemizer charitable deduction. So for married filing jointly, you can deduct up to $2,000 of charitable deductions, even if you take the standard deduction. So, and I think during the COVID years, I think they had like a $500 deduction like this, whether you're itemized or not. So they brought that back, which is actually a good thing. But again, and doing a lot of, over close to 70 or over 70 returns last tax season, the vast majority of people that I work with, even at higher income tax brackets or even lower, are getting the standard deduction. There's just not enough itemizable deductions out there for most people to qualify. So that was a whirlwind, as these stages always are. But I guess on a final note, I would just encourage you to really go back and think about, the life stage that you're in, what's most important, how do we gel that, or how do we mesh that with putting together a roadmap that really supports the lifestyle, personally and financially, that we want to achieve. To go back to setting purposes and objectives, and then, trying to take advantage of everything that I've talked about here with the One Big Beautiful Bill, and trying to avoid some of the downside pitfalls. And I just realized I could stop sharing my screen. So with that said, if you have questions on any of this information, we're easily able to be found. Check out our YouTube channel. I'm pretty active on LinkedIn as well. You can visit our website, tamacapital.com. If there's anything that I can help you with, please don't hesitate to reach out. Now that you've made it to the end of another great conversation, are you looking for more? If so, head over to tamacapital.com, where you will find all of our conversations. Use the search feature to find the topic or guest you would love to learn more about. Also, don't forget to make someone else's day by sharing our show. Thank you so much, and we'll see you next time.